Hello, this is the Global View on this Friday. I'm Andrew Gagan. Thanks for joining us here at AusBiz as we get across what has moved overnight globally, equities rising and Treasury yields dipping after soft US inflation data buoyed investors on the prospect of further rate cuts from the Federal Reserve. US consumer prices increasing less than expected in the year to November, and that saw Wall Street's main indices rebound from three-week lows led by tech and consumer discretionary stocks, with the discretionary sector jumping around 2%. Among the leaders there, Lululemon, which surged on a report that activist investor Elliott had acquired more than $1 billion stake in the athletic wear company. Starbucks also rallying. Among the tech stocks, shares in Micron Technology jumped after the company forecast quarterly profit and nearly double what analysts had expected on strong AI-related demand. Other memory companies, including SanDisk and Western Digital, also surging. Oracle recovered from a fall the previous session when funding plans for a Stargate data center sparked a broad equity sell-off. And shares in Trump Media and Technology surged after it and fusion power company TAE Technologies said they've agreed to combine in an all-stock deal valued at more than $6 billion. Well, US consumer prices rose a less than expected 2.7% over the year to November, well short of economists' projections of 3.1%. The delayed data showed that for the 2 months to the end of November, inflation was up 0.2%. However, the report showed households still faced affordability challenges, with beef prices increasing almost 16% over the year and electricity prices up close to 7%. Excluding the volatile food and energy components, core CPI increased 2.6% year on year, the smallest rise in almost 5 years. Meanwhile, in the UK, the Bank of England cut its key policy rate by 25 basis points to 3.75%, as widely expected, with Governor Andrew Bailey saying while he sees scope for some additional policy easing, the path the bank rate cannot be prejudged with precision, he said. And the European Central Bank deposit rate was left unchanged at 2%, while the central banks of Norway and Sweden also left rates on hold as expected. And attention today will turn to the Bank of Japan, which is expected to lift interest rates by 0.25 percentage point. US Treasury yields fell in the wake of the inflation data. The 10-year fell at 4.12%, the 2-year down to 3.46. And the US dollar index was up slightly on the day. The Aussie is trading at 66.1 US cents. On the commodities front, oil prices moving marginally higher on the likelihood of further US sanctions against Russia and the supply risks posed by a blockade of Venezuelan oil tankers. Brent crude up more than 0.5% at $60 a barrel. Gold edged lower off the back of the softer than expected US inflation data, with spot gold trading at about $4,330 an ounce. Copper little changed, as is iron ore. That's at about 106 US a tonne. And Bitcoin is trading at around 85,000 US dollars. Let's get across that movement we saw, particularly the macro moves. Kyle Rodda is joining us from capital.com out of London. Kyle, welcome back to you. Let's start on Wall Street. And I see you're saying that US inflation data could be too good to be true. What do you mean by that?
Well, there's sort of skepticism because of the shutdown of the US government over October and a bit of November as well, from memory, that some of the data collected is a little unreliable and maybe a little bit patchy, and perhaps doesn't reflect really what's going on in terms of the underlying price pulse of the US economy. In particular, to be able to get the November figure, the statisticians more or less kept housing rent steady as an assumption, something that has delivered actually significant pressures, underlying pressures and inflation in the US economy for quite some time. And so if you extract that, there's the fear that perhaps this number can't exactly be trusted. So we saw a big response to it. Obviously, it's a very big drop. It's good news if there is some kind of veracity to the numbers ultimately. But the truth is in the rates markets ultimately. Yes, the odds of a January cut increased, but only to about 26%. So still a 74% chance of a hold in January. And the odds of another rate cut in the year ahead rose a little bit, and the timing of that came forward a little bit as well. So there was a positive reaction to the data, but it was treated with some skepticism. And again, there's that sense that it may be a little bit too good to be true.
So, Kyle, we saw, as I mentioned there, equity markets lift on the back of that news, given that perhaps raised the prospect of further rate hikes to come potentially in January. Look, I mean, as well as interest rates, the other key thematic, obviously, that investors are focused on is that AI trade. We did get those results from Micron Technology. What effect did that have?
It reversed some of that bearish sentiment that was first elicited by Oracle's results and obviously Broadcom as well, which had reignited those fears about return on investment and obviously the valuations of some of these companies. If you do look at both price action and where we stand as we enter the final week of the year as far as valuations go, price action's flashing some amber signals, I think. A marked slowdown in terms of momentum in tech stocks, but certainly in the NASDAQ, the S&P 500, that failure to make another high should be noteworthy as far as, again, the technicals go. But crucially, if you do look at valuation metrics, one that jumps out, for example, is the CAPE ratio at levels only seen in history once before, and that was in the dot-com bubble. And if you look at other metrics as well, at risk of cherry picking, price to sales, price to book, above or at least around those levels that prevailed in the dot-com boom, that doesn't necessarily portend a significant correction for Wall Street. What it says, though, is that a lot of good news is priced in to the market and that there is the risk for disappointment. And going into 2026, I think that's really, the critical question for investors with that as the dynamic. What productivity and growth benefits does artificial intelligence bring to the broader economy and therefore deliver for companies and their earnings? And when will that actually materialize? And there's those concerns that perhaps maybe a lot of those benefits are already priced in and they are not going to materialize perhaps as soon as previously thought. And that's why there's that, very, very low level fear in the market and bearishness right now that's capping some of these gains, I would say, in equities.
Kyle, let's turn to your part of the world, the Bank of England cutting rates. That was expected. What's the outlook there for the UK economy at the moment?
I think it's mixed, and I think the vote split for the Monetary Policy Committee conveyed that. Effectively, it was Governor Bailey switching his vote from a hold to a cut from last meeting to this meeting that got the cut across the line. And the case was there because of the inflation data that we got earlier in the week, which was much lower than expected and very much welcomed. 3.2% is significant progress compared to where things were as of the last reading. But the UK still suffers from effectively stagflationary circumstances, or at least what was until recently stagflationary economic conditions of rising prices and rising unemployment or a rising unemployment rate. Growth is basically anemic. The last GDP figures flesh that out. And there are these structural issues now which mean that policymakers are dealing with a very, very challenging trade-off, like policymakers everywhere, but I think it's mostly acute in the Bank of England, between their price stability mandate and their responsibility to the labour market. And what you saw in the vote split was, although the inflation data raised these hopes of further cuts to come, and the markets are pricing further cuts to come from the Bank of England, it's a bit of a hold your horses message and let's wait and see from the BOE itself because of that, clear persistence in inflation that is worrying at least a number of those MPC members. So that sort of led to a little bit of a pop in the pound, which was priced for a little bit more of a dovish messaging from the BOE. Also weighed on the FTSE a little bit too. But at the moment, the world is sort of, for central banks, the central banking world is sort of riddled by this dilemma between price mandates and employment mandates. Like I said before, the Bank of England is in the most acute situation of perhaps any central bank of all.
So beyond what we're seeing in the UK, of course, we did have the monetary policy decisions from the European Central Bank, the central banks of Sweden and Norway. There's certainly a perception perhaps that the rate cutting cycle is over elsewhere. And that takes us to the Bank of Japan today. Kyle, in the Asian session, expectations, it of course is going to lift rates by 25 basis points.
Yeah, and I think, first on that point of kind of global monetary policy, I think that is something that will be a theme next year, is that we have more or less seen a global cutting cycle, or at least a cycle of accommodative policy prevailing across the world, and that's been quite synchronized for 2 years or so. I think that breaks down next year and we do start to see some divergence in policies. And this week's probably been a little bit of a microcosm of that, where we had the ECB hold, we had the Bank of England cut, and now the Bank of Japan meet today and are all but certain, based on rates markets pricing, of hiking rates by 25 basis points to obviously multi-decade highs. For the Bank of Japan, there is that possibility that it surprises us and keeps things on hold. They can sometimes, do that and blink when it comes to making a hawkish or difficult decision. Given the commentary that we've had, and also that there's been no pushback from the government and what have you too, a hike is almost, again, guaranteed. But the markets are still pricing another hike to come in 2026. By the BOJ's own reckoning, inflation is perhaps a little bit stickier than previously thought. Monetary policy settings are still accommodative in real terms, again, by their own reckoning. And we're going to have this really strong fiscal impulse coming through Japan next year as the Takaichi fiscal regime comes into place, all risking pushing inflation, which is already around 3% in Japan, core inflation, further away from target. So does the BOJ basically put its big boy pants on and talk hawkish and talk up the prospect of rate hikes? And does that bring forward the timing of the next hike in the market, cause a little bit of strength in the yen, a little bit of volatility in the Nikkei? Or do they kind of blink, avoid saying anything too hawkish, maybe say something outright dovish perhaps because of some of the GDP data that we've received recently out of Japan, which was very disappointing, and kind of balk a little bit, weakening the yen and obviously probably boosting the Nikkei. So it's the last big macro event for the year. Again, the central banks over the last week or so have been a bit of a microcosm of things to come. But for the BOJ, it's going to be fairly significant. It's probably going to be a hike. There are those memories of August 2024 there. I don't think we'll see that level of volatility, but nevertheless, it could be a crucial one depending on what guidance the BOJ gives, because the markets are betting that there'll be another hike to come.
Kyle, thanks so much. Really appreciated your input across the course of the year. Enjoy your Christmas break. Look forward to catching up with you in the new year. Thanks for joining us from capital.com.
Thanks, mate.
Kyle Rodda. All right, let's turn our attention to the local market then. We're expecting a very strong start. As you can see, SPI futures up more than 0.8%. Just a bit of corporate news to get across. Also unpacking further those central bank moves as well as inflation out of the States. Stay with us as we get across the open.